Hello, everybody. This is Patrick MontesDeOca with Trading Talk Live. We have the pleasure to have as a guest tonight Mr. Terry Lynch, CEO of Chilean Metals Inc. Good evening. Good evening, Terry. Thank you for joining us here in this Spare the Moment interview. And just for disclosure purposes here, I want to disclose that I have not received any compensation for this interview. I am doing it simply as I feel that it is a tremendous value to share Mr. Lynch's background in the gold mining shares to our subscriber base. Welcome to the show, Terry.
Patrick, good to be here.
Let's jump right into here. Tell me a little bit about yourself, your background, a little brief summary of pretty much how you got into the gold metal business, the gold mining business.
Yeah, you know what? I actually been a lifelong entrepreneur, generally speaking. I got into the mining business to actually help a friend out of he had made an investment into the company that I'm CEO of now, and it's basically more of a copper gold explorer in Chile. And the guys had sort of the management team that was running the place had tried to they lied to him basically, and we ended up having to do a proxy battle, and we got rid of them. And it's sort of that old saying, be careful what you wish for.
It fell in your lap.
And it's sort of like I say to my friend, because we're now sort of each own about 20% of this deal, and we both wish we were out of it. It's been a horrible time in mining for the last number of years.
Sure.
And and obviously even more compromised today. But we've learned some lessons along the way, and one of the things that we learned, one of the takeaways that I learned was that, while mining is a very difficult business, it's not easy. Mother Earth doesn't give it up very easily. She's tougher than the hottest, male or female you've ever seen in your life. She's super reluctant to
let go.
So that's just the nature of mining. So it's a risky business to begin with.
Mm-hmm.
But what compounded it is, it's funny, back in Canada in 2012, because I'm a Canadian, but I understand it's happened in the United States around the same time. In order to allow algorithmic trading to sort of come into Toronto, because I'm not sure if it's New York that did it first or London, but one of the big two did, and then Toronto felt like if they didn't do it, then they would be left, with some of their bigger listings would just leave, and so they decided that they wanted to let the algorithmic trading happen, which was fine. But one of the inadvertent consequences was there was a rule they called the Tic Tac.
Mm-hmm. Yeah, I want to get into that a little more in detail.
Okay.
Because that is something that needs to be discussed for sure. But okay. I kind of wanted to get an idea for our subscribers, basically what kind of a background you came from and how you came about basically becoming CEO of Chilean Metals Inc.
Yeah, you know what? I've been as I became a serial entrepreneur. I had some great businesses, had some businesses that weren't so great. Made some money along the way. Made more, lost some. Sort of like the entrepreneurial path. Always trying to sort of move one leg in front of the next. And so how it is. You develop friends or other entrepreneurs, other investors that you share a fellowship with, some sort of mindset or something, and that's typically how deals are done. People come together and invest money. So that's sort of what I've always done all my life. And mining is for me maybe 1% of my net worth, maybe today less for sure. And like I probably my biggest deal at the moment is involved in a very successful biotech. CBD, the purest pharmaceutical CBD on the planet, and that thankfully is doing great. So, it's funny, people say, well, how do you go from mining to biotech? And I say, well, actually, it's a very similar risk set. In mining, you want to find a resource first, and then you have to take the resource through feasibility and pre-feasibility, final feasibility, and then you build the mine, and then you start, selling your commodity. In biotech, it's sort of same concept. You have instead of a geological idea, you have an intellectual idea about, some molecule and what it could do to solve some, injured condition. And, you have to take it through phase 1 and then phase 2 and phase 3, and then you actually commercialize it, beast, but in a completely different entity. So that's what I've done pretty much my entire life, and I just wasn't built to work for the government. These days, I'm not sure that was a good decision or a bad one, but it is the decision that was taken.
It's always better to work away from the government, and hopefully, an entrepreneur is probably the best way to go, obviously. But given the regulations, given the, I think more than anything, I can use the word manipulation that pretty much has been taking place in the marketplace here since I can remember in 2008. We had this rally in the gold market, obviously, that brought us to 1900 by September 2011, and that was the top of the market. That's when I think everything changed as far as the price discovery is concerned.
Yep.
How do you been able to deal with this anomaly, so to speak, of pretty much price suppression and, through it all, staying alive in the business? It's been a very difficult business.
Honestly, it's sort of like that story about how to make a small fortune. You're starting to have a big one and get in mining, It's been, continuing to feed this thing. And I guess at some point, just like you're obviously a trader, and that's why I've come to you, is to learn more about this business. And in trading, you have a theory and you have stopped the position, you got your signals, and sometimes it goes against you, and you have to say, like the good ones, we're joking about there being old traders and bold traders, but no old bold traders. So at some point, you have to listen to the market, right?
Right.
So we've had to face that music in mining. So for example, in our particular situation, while we have a lot of great assets in the company, we haven't done much to move them forward in the last couple of years because it's just been too savage. It just became clear to me that it was, it was against all normal odds to productively risk capital and make a beneficial profit for yourself and your shareholders. So, and I was about ready to leave the business really about a year ago. Every year in Toronto in March, they have what's called PDAC, which is the Prospectors Developers Association convention, and it's the biggest mining convention in the world. It gets like 25 or 30,000 people, all trying to sell various mining wares, selling mines, etc. So they come here, and we were, we had a booth, on the main floor, and typically investors would come by. In the old days, this is where you met many of your investors, and they would, literally write checks, and you would get your drilling campaign fund, in that week. That was in the old days. Nowadays it's more of like an IR thing. But so what I found was that there was just like, as bad as the markets were, the attendance at the investor side of stuff was worse. And I just I was about ready to pack it in, but I said the real reason this is sort of I started this campaign called Save Canadian Mining. I actually have, funnily enough, SaveSmallCaps.com as well. That's because my version first was you gotta save mining to show it's possible, and then let's go save the rest of it. But because I fundamentally believe that we broke capital formation, normal capital formation, and fundamentally put the individual investor and at odds to the system, such that it's very difficult for him to make money now in a normal stock investment. And it's because the shorts, basically who largely operate offshore, like 90+% of them are not in the United States, they're not in Canada. At least their profits are. Some of them may be managing it from these places, but in most cases they're in Bratislava or or in Thailand and places like this. They're
untouchable places, right?
Yeah, untouchable. So you can't sue these guys. You can't get to them. But the complicity of it all, Pat, is that they're trading with our banks.
Right.
Okay. These guys. It's not like when you and you're teaching me how to trade. I'm talking to you. We're 1-to-1. Okay. These short sellers, they're not phoning up their broker at J.P. Morgan and say, "Hey guys, here are the 8 stocks they want to short today." That's not happening. They have a computer that talks to J.P. Morgan's computer. And I'm not picking on J.P. Morgan, just the broker's name that came to mind. And it just goes, electronically, and there's thousands of transactions every hour, every minute. And these things are based on, whatever that has been programmed into the AI. And they just look for, basically weak positions. So they look at the bid and ask and the balance sheets of these, weak companies, which is very easy to do in mining, and they just hammer down. So we did a study with a very, I noticed it. I proved it myself, but I realized I'm not a statistician, so I needed some more, proof. So I hired a very reputable gold mine research authority, and I said, I want you to, here's my thesis. I said, I believe that we've broken the structure since we've stripped out this rule, the Tic Tac. And maybe I'll explain that for your listeners.
Sure.
So they are clear what a Tic Tac is.
Yeah, absolutely.
So the Tic Tac was up until, from the time we started stock markets in North America till 2012, if you wanted to short a stock, it had to be going up. So think about that. If you wanted to short a stock, it had to be going up like day over day. So if on Monday you had penny mining stock that had, you had closed on Monday afternoon at 50 cents, well, you could short that stock the next day, but it had to be at 51 cents.
It had to be an uptick.
49. Couldn't be at 45. Okay, so that simple concept meant that people weren't piling on to deals and shorting them into oblivion. And that was a fundamental tenet of capital formation, and it allowed, capital to flow in, and it basically enabled capitalism to happen, successful capitalism. And then they did, target that rule. They basically,
it was a hole in the system, basically, that they left. They didn't realize because they didn't understand what trading is.
That's exactly right.
Yeah.
And so when we did this research, this will blow you away. So we did this research on the TSX and TSXV, which is, on the mining stocks, only on the TSX, TSXV, which is probably the number 1 mining exchange in the world. So get this. So here's the math. So if you look at day 1 of October 2012, when the Tic Tac was removed, and call that, day 1, the market price index was 100, and the commodity index was 100. In other words, day 1 it was even. So now, as of in late February, now obviously with the COVID-19 meltdown, we haven't redone the numbers yet, but I suspect it's even worse. But as just before the meltdown started, the commodity index was off about 7%. Okay. Okay. The stock price index was off 65%. 65%. Historically, the stock price index is slightly over the commodity index. So stocks trade a little bit above the commodity for some reason, historically, on average.
So it's negative now. It's under.
Now you'd have to triple it to get it back to even. So every mining stock on the exchange would have to triple on average to get back to where it used to be. So think about that. So how do you raise money justifiably, in an otherwise risky business when it's that much against you? So what I've tried to do is I basically got some, I'm not a high profile guy in the mining sector. I'll be honest with you. I'm just like a pissed off investor mostly, and I know some high profile guys.
You're in good company. You're in good company with this because it's affected some big players in the marketplace.
Yeah, so I got some, I got people like Eric Sprott, the legendary, chairman for Sprott Inc.
Yeah, just share with us. I appreciate. Yeah, I appreciate if you share some of the people that are behind this movement, so we can give our audience some idea that there is some significant players that are behind this,
and institutions as well, right? TSX is behind it. The Ontario Mining Association, Ontario Prospectors. So it's not just individuals; it's big structural bodies as well.
Where does it stand right now? How much progress have you made with it?
Yeah, so we're making a bunch of progress. Really, it's interesting. In Canada's securities is really more of a provincial legislation, not federal. So in Ontario, which is Canada's biggest province, it basically is you don't get anything done, across the country unless you can convince Ontario, just because its size and because it manages the TSX, our Toronto Stock Exchange, our biggest exchange, and the CSE, our second biggest exchange. So if you want to get securities rule change, in Canada, you have to get Ontario on side. So luckily, Ontario now has sort of I would say a small C conservative government that is generally, trying to, help capitalism and repair, some of the perceived damages caused.
So at least we can eliminate the predatory aspect of the business. This guy seemed to be completely unethical altogether.
Right. So now we've been dialoguing with the ministers, here, and we've been asking them to reinstate the Tic Tac. Now, since this was well advanced, I think I would say, in my view, it would happen prior to COVID-19. I would say I was thinking the time frame would be sort of fall of next year to spring of 2021, because government moves slowly, for lots of reasons. But that would have probably fit into the legislative, timeline, and that would have made, a huge difference in the mining market. Now, because of COVID-19, we're pressing the government, saying, guys, we're losing investment every day. Investors are losing money every day. You need to stop short selling, this predatory short selling now. So we're asking them to ban it. I don't know. I mean, look, Italy's done it, France has done it, South Korea's done it. Will Ontario? I hope so. I think there's a better than even chance that could happen in the not too distant future, like in the next month.
That brings kind of the current events, current situation here with regards to coronavirus here. What's your take on this? How does all of this kind of fit into the momentum that seems to be building, especially after this bomb, basically, that was dropped called coronavirus, which has completely demolished the financial markets, the gold mining shares, and pretty much has created just an incredible anomaly between the spot gold price in the gold mining shares. What's your take on it?
Yeah, I mean, that's obviously what sort of led me to you. Really, is my take is we've gone from sort of a fundamental. I've always been sort of a fundamental investor, like buy good management with good ideas and stick with them for the long term. But now I think we're at least for some period of time we're into a trader's market where where you need to understand how to trade in that. And not being a trader, it made sense to me to seek out leadership in that some thought leadership in terms of how to do this, because I think I'm putting it probably 25% of my capital to work in a trading scenario, because I believe that until a new bottom has been established, which I don't think it's been established yet, and I think it's
in terms of what, the metals markets or the equity markets?
in terms of the equity market,
Mm-hmm.
like I think we're off a chunk. I think my own gut feeling is they'll eventually sort this financial package out. The idiots that are running the world, and,
Yeah.
they'll,
Yeah.
they'll bring it to the table as best they can, and that will cushion the markets for a bit. It'll also be the takeoff point to the gold market, I think. And then I think what happens is we'll probably have, my own gut feeling, and I hope I'm wrong, is we'll have one more leg down to 50% of the previous high before we really find a bottom, and then go from there. But I mean, there's more learned analysis than this is just Terry's gut sense of things.
Well, recently, obviously, it has proven that fundamentals don't work. What just happened here recently just demolished the concept that you want to follow and trade based on fundamentals. And so what's happened now that the fundamental structure has been broken into the market, there is no other way of taking a look at the market but to look at the technicals of the market, to look at the math of the market and get some idea in terms of its technical indicators, as far as volatility and implied volatility, relative implied volatility. And, I mean, some of the moves that we've seen in this market here has broken the benchmark of conventional wisdom with regards to volatility, particularly in the gold market. We're looking at trading ranges of $150, $100 within a matter of 24, 48 hours. I've been, trading for quite some time. I've been in this business, but I have never seen what we witnessed recently, and I think if you really kind of want to take a look at the root of it all, I think you're scratching the surface of the poison underneath this, which was essentially this manipulation of price. Price discovery in gold disappeared because of this predatory short sellers that either they're central bankers or just vigilantes, taking advantage of, or a combination of both. But it's been very difficult because I believe, more than anything else, I believe that certainly has been a concerted effort to distract basically the American public from getting involved with precious metals, because they are afraid that if people choose gold over the U.S. dollar, obviously we can see the consequences. But again, we were talking about before the meeting here about energy, and I think what's happening here. Excuse me, if I can share some of the stuff I'm looking at it from an algorithmic point of view, from a mathematical point of view, is that the extension of this ranges now that we are seeing are truly historic, number one, but are setting the benchmark, are setting a whole set of new indicators, benchmark that are indicating some just unbelievable possible volatility. For example, we've seen the price of gold go $300 in a matter of months, 6 months or 3 months, whatever. We've seen some substantial volatility breakouts. I think what has happened here is that we have broken that model and have established now a new set of rules for volatility, which means that, some of these ETFs that are XXX, obviously, with the crash in the market, they're recalibrating it now down to a 2-to-1 factor. But I'm not so sure that it's going to make a difference when you're looking at the volatility to double or triple what it was. So even if they recalibrate some of these instruments, which they do, either by splitting the stock, you with me, at certain times, they always find a way to try to manipulate the instrument, and it's not for the benefit of traders. It's actually against traders. It's against the I believe right to free enterprise, so to speak, that somebody that's willing to take a risk and deal with an integrity, with a system that has integrity and validity, that okay, if you're willing to take the risk, and if I'm wrong, I'll accept that, but not to be manipulated like a herd. I think that the consequences truly are so profound, because number one, they've eliminated the demand that we need to have in the market, the demand of free enterprise in investment in gold mining shares. And so, it doesn't take a rocket science to, come to the conclusion that if they make it very difficult for people to have the confidence to invest in gold mining shares, eventually what we're leading to is a massive shortage of product. Nobody's going to be producing. Nobody's going to be developing mines. Am I wrong?
And I guess I think you're 100% right. And I think the scary part is, it'd be one thing if this is sort of like all market driven, like some sort of free enterprise sort of flow of pro and con ideas.
Mm-hmm.
But my sense is there's some, I hate to put on my, aluminum foil, but it just seems like so bizarre that all this is happening in the way it's happening. You almost can't sort of discount that this is like a game. It's like they're trying to scare everyone out so they can really rape and pillage themselves. You know what I mean? So now you have to have huge cojones, to, and I would not want to be trading on margin,
exactly,
because
exactly,
and
so this is the other side of the coin here that you just hit upon, that investors now obviously looking for aggressive returns, and you find aggressive traders that are willing to take the risk, and they have margin available for those that want to increase the leverage, you might say, and take the margin or buy a position on margin. But one of the things that has happened here that I believe is the process of deleveraging the whole system, because we've been dealing in a system that's been highly leveraged, particularly since 2008. We have not deleveraged at all. In fact, we've increased the leverage, the exposure, in the marketplace. If you take a look at the derivatives risk that we have built since 2008, because of all this shenanigans, you might say, of the Feds and central bankers playing, we were just getting out of hand completely. Again, I'm not sure that it's going to be easy to come back to find its mean, to find the equilibrium, to restore confidence in the marketplace, you with me, and allow basically the free enterprise, the capitalistic system, to allow people to find an alternative, you with me, a vehicle that they can use to improve their lives. That's what this is about. If you're willing to take the risk, this is all what America is about, isn't it? Or free market enterprise. But instead we've seen just a tremendous amount of manipulation against the Main Street, raiding the equity of what I believe is the positive aspect of Wall Street. But Wall Street doesn't have a good good connotation, a good name, kind of, and so it's buyers beware. But I think what's happening once again is that they're running out of time. They're running out of ways to manipulate, and I believe the gold market is waking up to a demand that we haven't experienced in the history of these markets, particularly right now. When we have this coronavirus literally being the catalyst to destroy the financial system. I mean, look at the amount of money that's being poured into the system, far greater than 2008, and we're not looking at any effect. You know, they're throwing money, good money after bad money, and so it kind of leads me more to begin to think that the metals markets are in a position, even before this coronavirus incident happened, they were building, a pretty bullish uptrend. They broke out of 1375. I mean, we got up to 1700. We're hovering 1800. And so we're making higher highs in the gold market. And the gold market is beginning to anticipate, I believe, that we have some serious problems in the economy, in the world economy. And one of them is over leveraging, which is what happened with these gold mining shares. They clobber them because those greedy guys that buy triple X velocities had to go on margin to even multiply the leverage and increase the factor to a point where it destroys a market when it does what it did recently here. So I think I'd like to be optimistic. I think that as I said, as far as I know, and just the law of the universe is that you can only suppress this energy so much before it reverts itself into its natural mean. And when that happens, and I believe they are beginning to realize that they can't manipulate the gold market anymore. I mean, if you take a look at the market in gold right now, in comparison to all the other assets that collapse, it's holding pretty good.
Yeah, no doubt. In that sense, it's not unhistoric its current response. I mean, I think it's not untypical for gold to sell off like everything does when you have margin calls and liquidity crunches and so forth. But at some point pretty soon here, one would expect to see, especially with the helicopter money being thrown around, that there should be a rip up in the gold market of, as you say, like it seems like these rips are more compressed now than ever. And, Jesus, you want to be on the long side of that rip because it's going to be it's going to change your life.
Absolutely. What do you see? What do you see as far as prices? Just not trying to corner you into giving me a forecast, but just to get a feel what you're thinking.
My own thinking is it probably trades in the 1450, 1550 range here until the U.S. Comes up with a fiscal plan that's approved by the House and Senate, and I think once that's announced, and it's obviously, I mean, we're all reading these concepts that they're rolling out right now. This is we had QE1, QE2. This is like maybe QE 1,000 or something.
QE to infinity. QE to infinity.
Yeah, exactly.
Absolutely.
I mean, it is beyond and beyond. So I can't imagine that once that is actually like locked in, that this doesn't really amp the gold market, and that would be when it sort of becomes where people go and now they're going to manage it. It's not going to, it probably should be ripping through 10,000, but it ain't going to get there. But is it going to break through the old highs at some point this year? I would think so.
Terry, as much as I love gold, and as much as I would love to see it go to 10,000, I would hate to see the status or the state of the world economy that we are in at that point in time for gold to be at $10,000. I don't think it's going to be a pretty place.
You know what, though, Pat? Here's a contrary thought to that. Like, if it was just an explosive rip up, without it sort of doing anything, that would be one thing. But don't you think? Like, I mean, I think capitalists. We're capitalists. This is why we're on on the call together.
Mm-hmm.
We've made some money and we want to make
Sure.
more money so we can provide a better life for our
Sure.
family and so forth. And so we believe in capitalism. And I think, as we moved away from the gold standard, we got into this bullshit of making a lot of enabled bad decisions that continues to go on today, and leads to improper price discovery. And I think if I wouldn't be surprised if the ultimate resolution of this is going to be like a nightmarish scenario. But I think that maybe at the end, the central banks come together and say, hey, you know what? We need to have we need to stop this. And Trump is the type of guy to do this, in my view, because he's not a globalist. He's not owned by the system. He's just
he's against the status quo for sure. Yeah.
He's just enough of a maverick to say, you know what, we're gonna go back to, we're gonna make if you actually run the math, if they actually do have the gold in Fort Knox, and that's a conversation for another day. But if they assumably they have that, then 10,000 would be the number to balance the budget. Something in that range. And then if you add an actual fiscal regime there, and you made things transparent, that might be how you rebuild this thing, because people are going to right now we're all in shock. Okay, everyone's in shock. People have lost 30, 40, 50%, but that's just one shoe. Wait until their houses go down by 30%.
But why haven't they done it right now? 50%. If that's the case, Terry, my question to you: if that's the case,
these
why haven't done it by now?
Because smart guys in the room who have a voice and influence are on the other side, and they don't want this to go away. This has been their cash cow, man.
Right.
Look at how often they've been raping and pillaging. Every time this thing gets, these guys make huge money.
Sure.
And then if the thing goes up, they make huge money. If the thing goes down, they get a bailout. Personal
interest seems to come first. That's another argument as far as the way that these politicians seem to do things. That it's really questionable. But when it comes down to these markets, I do think that we're coming to a point where this is going to be resolved either by the market itself or by people like you that are challenging this kind of trading and are fighting for the common people to create the opportunity to create possibly another way, another vehicle for the common man to come in.
Yeah, and there is some good people out there in government. They're not all crooks. And I think they're a bit overwhelmed, and they're they're somewhat surrounded by a system that's been slowly subverted. I call it boiling the frog. That's what's happened to us. That concept, right? So I think, but Trump was probably the first guy that woke up. In a funny way, in Toronto, we had a mayor, Rob Ford, he was almost like a predecessor to Trump. He was a super non-politically correct guy, and he did a lot of goofy things, but he was he did really want to do good for the people, and he did a lot of good. So I think populist leaders who are actually don't have an agenda, aren't trying to fill their pockets, actually are trying to make better legislation that would help us all. I think more and more of them are coming to the table, and the more these guys become caught in their lies, and the media gets caught in their lies, and people like you and I get on and have real conversations about real things, the more people get woke, and maybe we wake a few more people up each time.
Right.
And eventually, we're going to get the change we need.
I think this optic rule change could make a very, very significant change in the way that we priced gold mining shares, obviously. And it could really make a difference. And it may be just the time, especially if we're looking at a potential bottom here in the gold market with all these other, economic issues at hand. It only makes gold more attractive pretty much as a currency, especially if we're looking at the U.S. dollar in jeopardy here with all this debt that we're carrying and obviously bringing interest rates down to zero. It's beyond me that people would go into the dollar as a safety haven, with the possibility that we may go negative rates, and then they got to pay to be on the dollar just for the safe haven.
Yeah, I mean, it is.
It's bizarre.
It's crazy, but look at if you're not Aussie,
Right.
Have you seen the Aussie? Have you seen the Aussie dollar?
Oh, it's pretty much what is that, 60 or something in that 60 cents?
The last I looked, it was 55.
Oh, my goodness.
Down from 80 cents
Yeah.
in December.
Yeah.
55. Imagine losing 30 points in like months. Now, I mean, the Canadian dollar probably got crushed too. Not as bad, but so it's like, those types of moves, so I have to pay half of 1%, but I might pick it up on the currency.
It's my theory. My theory, after living through Mexico, as I shared that story with you in 1981 with the Mexican peso, is that as you know, in most third world countries, primarily in Latin America and so on and so forth, Mexico is one good example. That how many times have they forfeited on their debt? And it's not chump change. It's
no.
It's big dollars, and we continue to provide them, with loans and refinancing and all that. But what happens to that money when it's not paid? And so I think the time has come to pay the piper, basically, because all this stuff has become rotten, into the system. And this is the poison that I believe is being cleansed right now by the mere fact that the system cannot sustain this kind of corruption anymore, this kind of manipulation anymore. So with a positive light here, I want to look at what's happening here is a transformation. It's an awakening. It's very positive. And we need to be calm, collected, to allow for this process to materialize itself, because I believe that when it does, it's going to be extremely positive. I believe that you have the forces with you to be able to make a change in this ruling here. I believe that you are one of the few that are spearheading towards the right direction to be able to bring back the system into a level of integrity, so that we can have the trust and the confidence of people to come back into the economy, to invest, to trust in investments, and to make this country what it could be.
Yeah, I agree.
What are your last thoughts, Terry? Any last thoughts here to our subscribers?
Yeah, I guess I wanted to ask you, in your own opinion, you're obviously, you've got a trading system, and you've seen the trading system work in what I would say normal times. Now you're seeing it work in abnormal times. And is your view, is it more effective, less effective? What's your gut feeling? I guess my feeling is, in these crazy volatile times, these types of systems are going to be more effective than ever. But that's just me, and I may be completely wrong, but I wanted to get your view on things. Well,
as I mentioned earlier, the fundamentals of the market have been completely broken. And so when price experiences the breakdown in the fundamental aspect of it, it adheres to its technicals. It adheres to its internal mathematical composition, because the market is a mathematical matrix that essentially it's a simple concept of supply and demand when you really think about it. That's the basic, I think, function of the market, that it gives you the opportunity to exchange the supply and demand equation. Ideally under normal conditions, without much volatility in between, and so that you can have the equilibrium of stability of prices. What happens here, such as in recently here, is that the volatility factor pushes the price to an extreme. And I call that the rubber band effect. That you can pull prices up to a point that either they're going to break or they retract. They retrace to its equilibrium. And so understanding the principle of the reversion to the mean, which is a universal law that you can see it everywhere, day, night, midday, emotionally, we're angry, we're sad, but most of the time we're even, emotionally. And so it's a natural law that applies to measuring the extremes of energy, for example. And so in applying that philosophy, so to speak, in terms of the market, what we have done is we've taken into account that the energy is basically a product that you can measure, an entity that you can measure, that it has a beginning, a middle, and an end. And, it has a bottom and a top, or, a trough, and you with me, and the top, it's a wave count that goes up and it comes down. It goes up and it comes down. I use the example of a rock. When you throw a rock in a pond, that you see the rock hit the pond and you don't see the damage that causes while the rock goes down into the pond, but you see the ripple effect unfold on the surface. That's what happened here recently. The foundation fundamentally was broken, and so the market went into this mathematical dimensions, basically, where the prices went to extremes. But they're not going to break. The system, the matrix is not going to break. What it's going to do is retract and go for a period of time, you might say, whipping volatility like a wet rag, you with me, until it finds its mean, its balance, and then it becomes more stable. And then once it does become more stable, then you can begin to extrapolate the extremes above that mean or average, so to speak, into different, time frames, depending on how you look at the market. From my perspective, I apply that and I put all the trends together. I use that on the daily trend, the weekly trend, and the monthly trend, because the market breaks up into trends. And so defining those trends is very important in terms of how you trade your portfolio. Whether you're a day trader and, you go home flat every day, or you day trade and also swing trade, that's holding a position for more than, a day and eventually into a position trading situation that could be long-term. And that would depend upon what level of the energy it's in. For example, if I use as an example, and if we take a look at the equity markets right now, and if we take a look at the gold market right now, the gold market has come down to an extreme level, and it has identified basically the 9-month average price at 1454. Okay. Below that, you're looking at the VC PMI at about 1417. I'm using this as an example, going back maybe to the annual cycle, just to use the current market as an example. The gold market was roughly, 1,200 and change back. It was 1,500. September 28 was about 1,500. It had gone up from about 12 and change into that 1,500, and it broke above that level. And it, as I said, when we can identify the average price, whether it's a daily, weekly, monthly, annually, 9-year cycle, 60-year cycle, 40 years, you create that structure within the time frame that you're analyzing, because it's like a GPS that measures the extreme levels of supply and demand within that time frame. And so it gives you a perspective idea of where those extremes are of that energy, for example. And coming back to the gold and the mini, we are in an area where the prices have come down even to the extreme below on a long-term basis. It's way off the mean. And so regardless of whether, we got a bottom in a new bull market or whatever it is, what happens to that energy is it has to adjust to its mean. And so as a trader, I don't really care what, the big picture is or where the market is going, or, in that sense. What I'm interested in is in trading within the structure identified by the VC PMI, which gives you the extreme of the supply and demand levels within that time frame. And so, what I have learned is that the markets basically are energy. And in using price, as I used to before, a price was really the result of that energy pattern. And so if you use price as an indicator, you're going to be upside down to the energy. That's why sometimes when you get this technical analysts coming out with this, technical signals, it closed above the monthly, the weekly, blah, 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 blah. And all of a sudden you see the reversion occur where you get a 50% Fibonacci retracement before, it goes back up again. And I did that for many years. I was, I trade options and I do volume. And of course, when you're trading premium, the worst thing that can happen is that the market will go against you right away. Your time decay just comes in and it kicks you in the butt. And those premiums just collapse. And so I love this business, and it became a challenge for me to understand the dynamics of what was happening until I understood that when that signal comes in using conventional wisdom, it's usually time to go neutral and allow for the energy to revert back to its normal equilibrium. When it does, that's the time to enter the trade. So the program that we wrote, the algorithm that we wrote in C++ in TradeStation tells you don't trade the mean, don't trade the average, because the average is 50-50 standard deviation. It can go either way. As a trader, what I tell my trader subscribers is be patient, wait for the price to go to the extreme above the mean or below the mean. Because the cell one, in terms of the algorithm, identifies that level to be a 90% probability factor. It's a probability model. It's a momentum model. And so as a trader, I don't want to trade 10% probabilities. So I wait, the price goes to cell one, it activates the trigger point by closing below. That's a short trigger. Now I have the intelligence telling me that it's a short trigger. Then I can apply my experience as a risk and money manager in how I want to manage that risk. It may not necessarily be the futures, you see. So you lay out a number of potential opportunities that develops, once that signal is triggered. The obvious is take the futures, take the short, or you can synthesize it. You can buy puts, you can sell calls, you can sell short calls. It creates a whole menu of opportunities. Which is terrific, because what it does for me is it keeps me out of the guessing game. When you come into the floor, I don't have to wait for the price to tell me what I need to do. I already know. I wait for the price to activate the pivot point and for the confirmation to come in, and then to execute the signals. So it's a more methodical, systematic way of executing than following conventional technical wisdom, pretty much, that 90% of traders out there, pretty much, give it up,
Yeah.
And I always wanted to be one of the 10%, because it's very simple math. The 10% make a bloody fortune under 90%. That's just the way it goes, If I'm willing to take the risk, then I want to have the odds, the probabilities, the math going on my side. And so where we are right now, in fact, I hear a lot of money managers, a lot of traders, on CNBC, whenever I watch it, they're talking about they have to rely now more on the technical aspect of the market, because the technical aspect of the market is what's going to pick the bottom, not the fundamentals.
Yeah.
Does it make sense?
Yeah. Yes, indeed.
It's been a pleasure, Terry. Truly, I enjoyed talking to you. I really admire what you're doing. And for the benefit of our subscribers, tell us how they can reach you and get in contact with you.
So best to go to savecanadianmining.com, and you can register there and just support the initiative just by just signing up, and you can contact us through there. There's emails and so forth. So just Terry at savecanadianmining.com is probably the best way, and be happy to provide any sort of feedback I can, and let them know what we're doing.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our variable changing price momentum indicator, VC PMI, is an automated AI trading system developed and tested over a decade. The VC PMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VC PMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VC PMI algorithm. The VC PMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VC PMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VC PMI? The VC PMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VC PMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VC PMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit EMA2trade.com for more details.
Yeah, sound advice. I'm speaking with the founder and CEO of the Equity Management Academy, Patrick MontesDeOca, who runs the mean reversion trading marketplace service here at Seeking Alpha. You can sign up for mean reversion trading either by going to seekingalpha.com/marketplace and looking for mean reversion trading, or by typing mean reversion trading or Equity Management Academy into the search bar at the top of the site. Okay, so you mentioned risk management, and of course the system that you're using here is probabilistic, which means that it's not going to nail the direction 100% of the time. So what sort of things do you do or recommend to people via the Academy to manage risk?
Well, first of all, when you go in, let's say we use the factor of the principal investment equals X. Okay. And so if you have the X factor clear in your mind and that equals 100%, okay, then depending on where the algorithm is in relation to all the trends, for example, you can begin to activate percentages based on that. For example, if we were to be in the market yesterday in the metals, and we recommended to get out and to be looking for a reversion, okay, to occur. We went flat, and basically we identify the three trends, the daily, weekly, and monthly trends, to be almost at the same price. When the price came down below the critical level that we look at, it activated the reversion. And so that was a time that it identifies for you potentially a trend direction short term. And it could be a duration of maybe a couple of weeks generally until the prices come back down to align themselves on the B1, B2 level, or the level of demand, you with me? And harmonically aligned itself into the daily, weekly, and monthly numbers once again, which will be at the extreme below the mean. And so those times are times where you can manage your position a little more aggressively, you know, when you identify the harmonics in the trend. Did I answer the question?
Yeah, I think so, definitely. So in terms of you are using this system to trade S&P 500 minis, gold and silver, and just have to ask why these three assets.
Let me for a minute finish this question regarding the risk, because when you identify the portfolio of 100%, let's say that you're willing to commit to the market, then if you have, for example, a perfect alignment in prices like yesterday in all the three trends, then you could be buying, like I was for the mini, the bear ETF, which is the SPXS.
Right. Well, is that the Pro Shares?
That's the
triple.
bear. That's the
triple
3 to 1.
Uh-huh.
It's a triple leg. Yeah, exactly. So because I'm an aggressive trader, you with me? I want to play the aggressive play, and I'm expecting the prices, like I said to you, based on the VC PMI, is anticipating a reversion back down into the harmonics of blue again. You know, I want to ride this, the SPXS, which is the bearish ETF. And that's where I've been trading for a hedge fund that I'm managing, which, by the way, is up about 10% for the year so far. And I'm applying, actually, the automation of the VC PMI to manage the fund.
Nice.
Except that I'm using that in security. So what I'm showing here is that the signal, although it's a directional signal in the futures markets, the application can be exponential based on your size, based on your particular situation individually.
Sure. And so is everybody basically just trading the S&P 500 gold and silver, or can this system be effectively applied to other assets also?
To answer that question again, I'm sorry. Yeah. First of all, the answer is yes. It can be effectively applied with same probabilities, because the program will adjust to the volatility of each individual market. And the data that it will provide will be based on that.
Sure, although I understand that. Okay, so I would assume the underlying volume in a given asset would determine how robust that probability is.
That's exactly the reason why I trade gold, silver, and the mini, you see. Because it's liquid, it's volatile, you with me? And for some reason, I'm finding that the relationship of the indices to the principle of the reversion to the mean is even more accurate so far than any other market that I've traded. And it may be that because it is a paper market, you know, meaning stocks, and the futures itself is the underlying, is you know, the paper, so to speak, than the commodity. So that the risk management is done based, once again, on where it is, where the price is in relation to the trends. For example, if it was yesterday, going back to, where the price was in the metals, or the E-mini is, for example, you can use this position to accumulate, for example, the bear ETF in all the three trends. And this is where you may come in and take a 20%, 30% of your portfolio in this position. You see? And so upon confirmation, you go into 50%, and so that eventually, when it breaks out up into the reversion completion, you should be long maybe 80-90%. But when it reaches the target, you liquidate 90-80% of that, and you go back to maintaining a very small risk position, or you liquidate all of it. Depending on if it reaches the extreme level, you might say again, of the reversion to the mean above. If you buy it below and it goes all the way from B2 to sell 2, let's say, then yes, of course, then you lock in your profits up there. So it doesn't matter where the price goes, the market will give you a structure to trade from, where it identifies for you the probabilities above the mean or above the average with 90-95% probability, or below the market with very, very specific levels, and also 90-95% probability.
Sure, and you have tight stops in place, I would assume, on the upside and downside?
See, when you enter the trade, automatically the stop is identified below. Like I said to you, on this trade that was done earlier, the entry was 27.75. The stop was 27.76.
Yes, but what if it moves in the opposite direction, downwards?
If it closes below 27.76, you get out. If you didn't take profits today, when it gave you the chance, the close below was 27.75.50, so you'd be stopped out.
Gotcha. Okay.
At 27.75.50, your entry point was 77.75. That's your risk. You're flat.
Gotcha. Okay, cool. Gotcha. Yeah. So that's the risk. The risk control is happening through very tight stops.
And in other words, when the order is activated, it immediately activates the stop above or below, or the target above or below the signal. Immediately.
I said I was going to ask questions about what vehicles what your preferred trading vehicles are for gold.
The JNUG for gold.
Okay.
That's a minor ETF, but it's XXX. It's the bull.
Sure, although it's not direct. It's fairly directly correlated.
The underlying
to the
is the GDXJ, which is 1-on-1, and it does follow very closely the futures price. And because it is a XXX ETF, as I said, I'm an aggressive trader, so we're talking about the way that I manage the risk. And because I have the tools to help me manage the risk, which is the VC PMI, then, when I get a directional signal, let's say, in the automation, then I apply the exponential application, where I go in and I buy 1,000, 2,000, sometimes 10,000 shares of JNUG. And if I want to eliminate the margin, for example, okay, this is a very critical point. I recommend traders that trade the futures markets, regardless of how financially set you are, to day trade the futures markets and position yourself in ETFs. So that you can basically hold the position overnight. Because I don't care how well financed you are, trading in the futures markets can be treacherous, particularly in the Globex. So if you let's say like yesterday, or where we are now in the E-mini, for example, where the reversion is giving confirmation based on the action today, that is reverted back down possibly into that low 2700. So how do I take advantage of that signal? Well, I don't like the futures risk. I got a confirmation of a short signal happening. You with me? Therefore, I can buy the SPXS ETF, which I did, and I covered it by selling calls way above the market and collect credit. So I'm done. I bought it. My average price is $22.50. I sold it at 25, 24. I collect, a credit. I'm done. The market runs up there. It takes me out. I make a nice profit. If it comes down, it will eat the premium of the call, you and me, which I will keep, and I can always be writing against the ETF if that's the case. So it's a question of how you manage the risk, and for me, as I said, I'd rather be long. I think the futures margin is, let's say, for overnight position, maybe it's about 10, 15,000, depending on your broker, I'd rather take that money and buy the SPXS or the L, which is the long, and carry the position, because since these ETFs are triple X ETFs, when you get a 2 or 3% move in the futures price, they're going to give you 10, 15%, sometimes 20, 30% in a day.
Sure, yeah, and a super big move in one direction, definitely. And how long are you holding? You're saying overnight, but you're not holding these funds for
the day trades. I day trade the future and I get out at the end of the day. But if I want to hold it into a swing, I convert it to an ETF. And when I get my price, which is generally sometimes 2 or 3 days, I get out. And so I'm building trades where I go in and I pick up a couple of grand here, a grand here, 800 here, but I'm active in locking in the profits. Now, that's managing my position short term. Okay, so depending on where the market is, again, it will give you the opportunity for you to manage your position short term, put on a swing, and put on a position trade where you can buy and hold for a month, or if you're looking for a trend to unfold. Yeah. So the market will always tell you, and the relationship of the price between the trends will identify for you and me, the bigger picture in terms of the trend direction that you may have. Point in case here, the market is coming down 27.7150 on the ES, and the revision now is on the weekly is working. Because the weekly signal came in short, and the target is 27.52, the first target. The daily already, completed the buy one target, and now it's looking at the sell two target of 27, the buy one target of 27.66. Okay, hear me out for a minute. I just told you the buy two target in price is 27.66, and I told you the weekly average is 27.52, correct?
Yes.
When the price equals the same, that's what we call harmonics alignment. So we're very close to that. You see what I'm saying?
Yeah.
And that's how we connect the day trend with the weekly trend and the monthly trend, and it's purely mathematical.
Yeah, no emotion involved at all.
Yeah, exactly. You can hear by just the way I talk. I talk numbers. It's like explaining to you the multiple table, so to speak.
Totally. And sorry, just because you had mentioned silver also, is there a preferred vehicle that you use to trade silver?
I used to trade the USLV until they broke the stock, so to speak.
They rolled.
Yeah, I think it was 3-1. They split the stock, and it became very expensive. So the other thing I want to point out to you with regards to the metals here, which I think a lot of people that have been trading the metals have experienced, and that is in fact that the metals have been completely manipulated away from its equilibrium price, or its real mean, or its real average price, and which is what's been going on for the last 4 years. And so it's a different dynamic when you're trading in the metals, so to speak, than you might say the equity markets, because the silver market in particular is a very thin market. And, large traders, bankers tend to use that market to control the price. The price of gold. If they can't move the price of gold the way they want to, they'll use the thin market like silver, for example, to affect the price. And so that movement is an artificial movement that has nothing to do with the actual function of the price of the market, because it's manipulated in that sense. But what the algorithm will do is it will identify for you when they get it to an extreme level.
Mm-hmm.
You with me? And when they get it to an extreme level, it will go harmonic again. The prices will link. And that's when the program will tell you, regardless of the energy underneath, regardless of the reason why the market went there, look for a reversion to occur, because mathematically, and the physics of the market of trading tells you it's reached an extreme, a 95, 98. When the three trends are harmonically aligned, it's like 100% probability of the reversion to occur from there. And if you want to go trade against that probability, good luck,
Sure. So I had one other question I've been meaning to ask here, and that is, are there ever kind of extreme market conditions, let's say thinking back to 2008, 2009, or maybe even going back earlier than that, some of the market disruptions in the early 2000s or late 90s, or maybe 87, where the system just totally breaks down and your basic advice is just stay on the sidelines until things kind of straighten out here?
That's a very good question, because that's what happened to me in 2008. That I only had one algorithm, and when the market, for example, in crude as an example, I was long crude and I had like a huge profit. I had like 100 and something % profit. Yeah.
I was going to say, is that when crude was basically over $100?
Yeah. For me, the program, had a profit, but it didn't follow. The stop didn't trail it. It didn't adjust to the volatility. And lo and behold, of course, when the market collapsed, I wind up giving all the profit, and I think I netted with about 23% profit, after being up so much. And of course, the market collapsed in 2008, and I was a victim of MF Global, that $1.3 billion disappear of equity funds, and unfortunately, I had my business with them. The automated program was traded in their platform. I think it was Strategy Runner. And so,
and it wasn't FDIC insured or anything.
You can read about it if you Google it, and it didn't matter if it was insured.
I don't remember the exact
very
logistics
painful,
of
very painful experience,
happened.
And you never get your dime, your money back. They give you nickels and dimes, if anything. But I always learn. I always have the philosophy: what can I learn from my experience? What is it that I can learn from here? And in fact, what I learned was that I had to take the algorithm, and I broke it down and created 3 different components, 3 different trends, 3 different algorithms out of that, because I had to break it down and find out how I can adjust the algorithm to the volatility of the market, so that, the same thing won't happen. And so what I did is I adjusted the algorithm so that it will tell me when that happens. And when that happens, if you read closely in some of the instructions that I have in there, or the book that I wrote, usually when the price closes above the sell 2 level, okay, which is the extreme above the mean level of resistance, okay, the price will activate that resistance as support. It will convert that resistance to support, okay? And that support now connects to the weekly data. So instead of looking at the daily data, automatically, when it closes above sell 2, you look at the weekly data. You look at the weekly signals. And it tells you when it closes above sell 2, you don't sell to open. You don't go short to open. You only sell to liquidate. I'm sorry. If you're on sell 2, you don't buy to open. Excuse me. You don't buy too open. You don't buy too open. You only look to sell once you get the confirmation. Because, as I said, like say here, for example, today's rally was the sell to level is 2801. Okay, that's the resistance today. That's the sell to level. If the price had closed above 2801, it would convert that resistance to support. And that sets the price fractal higher, and then it falls into the weekly and the monthly patterns. And you with me? And for example, like in the gold yesterday, that happened, and then you looked at the monthly data because the weekly broke above the sell 2, and the weekly the monthly sell 1 level was 27.98. So when the price of the daily closes above sell 2, you look at the sell 1 weekly, where it is in relation to that. And more than likely, it's going to be pretty close or above it. Particularly if it's harmonic, is what I'm saying. You with me? And then if the weekly closes above the sell 2, then you look at the monthly.
Yeah.
And so when that happens, you are going to find that all the 3 trends are in red, are in supply. Like in the E-mini yesterday, like in gold yesterday. And that tells you the system is going to change. And don't, in other words, it can go higher, it can go into that weekly sell 1, you with me? And so it tells you now, on the daily, if it closes above the sell 2, you don't open positions to go short there because it can go higher. You wait for the market to correct to the buy 1 or buy 2 levels of demand to get long.
Sure. So there's really a lot of positioning and repositioning happening over the course of the day in this.
If the price is what dictates that.
Yeah, sure.
You see, and so, but there are only certain strategies that the market will do up or down, or sideways, that within this structure is my point. And I know it's very difficult to comprehend, what I'm saying to you in terms of understanding the dynamics of the harmonics that we talk about, but it's basically the price equals the same on all the 3 trends, and when that happens occasionally, maybe a couple of times a month, is when the trend usually reverses. It tells us, the system has changed. You don't, if you want to day trade, then look to, when trend traders identify this, they usually say buy corrections only or sell rallies only. You with me? It's that artificial intelligence that's built into the algorithm, and that is the artificial intelligence that I coach and teach self-directed traders. There is one thing that I've experienced here, which is basically to use the automation, as an indicator or as a tool, so to speak, for me to trade my self-directed account a little more intelligently. It just makes all the sense in the world. I suggest don't let the automation, don't take it for granted just because it's automated that it's going to produce, $1 million for you overnight. You still have to manage it. Even pilots, when they fly the plane on automation, they still have a co-pilot watching it.
Yep, and in certain conditions, they got to take the wheel.
Yeah, exactly. Yeah, so you want to be aware, prepare, but this takes a lot of the stress out, the emotion out, and it makes you trade systematically, methodically.
Yeah, no, sure. Fascinating stuff. This has been really great.
I appreciate it.
I was wondering if you had any final words for our listeners before we go here.
I think one of the things that is important to recognize for me, for example, is that when I decided to become a trader, I decided to accept the responsibility of a trader. And that is discipline, consistency, how to manage your emotions and how to control your emotions. When you go into trading, look at it as a business venture. Like you're going into the business, like you're going into a business. And the business that you're going to is you're going into every business if you're trading commodities. You can be in the gold business, you can be in the silver business, you can be in the indices, you can be in stocks. Your business as a trader is every business out there that you feel that you can trade. Okay. But as a business, you want to specialize, you and me, and maximize based on your goals, objectives, profit margin, so that when you begin to run your business and you begin to show a profit consistency, a consistent profit ratio, so to speak, don't be greedy, emotional, that when you have a profit, you don't take it, you want more, you wait, oh, I'm going to get a little more, I'll wait a little more, or change your strategy from day trading to swing trading. Don't second guess yourself. Be very definite about your trades. Go into the market knowing exactly what you're going to do. Do not be influenced by the chatter out there. Try to be independent. Try to isolate yourself into the work that you do. Because if you do the work mathematically, math don't lie. Mathematics always tells you the truth, as opposed to fundamentals, as opposed to CNBC, which is trading blind. And so for myself, what I would say to you is, create a process for you. For example, just to share with you, and it doesn't mean that, you have to do what I do. Every morning I get up and I meditate for an hour. I run, I do yoga before I come into trading. And when I come in, I'm fresh. I'm completely clean. My thoughts are clean. You with me? I close my doors, and it's silence and me in the market. I have my tools. I have my numbers in place. I have my screens all set up. There is no stress. I don't need to worry about where the market is going. I don't need to worry about the chatter. I don't need to listen to the news. I only need to trust myself as a trader and try the tools that I'm working with. And so time and time again, as I've done this discipline, I have found that whenever I second guess it emotionally, as a trader, I will. And I continue to do that, because I'm human. I'm emotional. Every time I second trade it, it proves me wrong, as opposed to just following it, right or wrong. And it will not be right 100%. But if I can go in there as a trader and make 60-70% of the range that I'm looking to make, I'm happy. So discipline, passion, patience, and manage your emotions is what I would recommend.
Nice. Sound advice. I like that. I think that's a good place to leave off. Anyway, thank you so much for joining us today. This has been great.
Thank you so much, Jonathan. I look forward to next time.
If you've been enjoying the Seeking Alpha Marketplace Roundtable podcast, you can subscribe through iTunes, Apple Podcasts, Spotify, Google Podcasts, and Stitcher. You can also give reviews on those platforms to help other investors discover this podcast. We just spoke with CEO and founder of the Equity Management Academy, Patrick MontesDeOca, who runs the mean reversion trading marketplace service here at Seeking Alpha. You can sign up for mean reversion trading either by going to seekingalpha.com/marketplace and looking for mean reversion trading, or by typing mean reversion trading or Equity Management Academy into the search bar at the top of the site. You can also follow Equity Management Academy on Seeking Alpha and enjoy their free content there. For disclosures, I don't have positions in any of the funds mentioned in today's show. Patrick MontesDeOca is a day trader and thus may have positions in JNUG, JDST, SPXS, SPXL, as well as the futures of the S&P 500 Mini, Gold, and Silver.